You're in a winning trade. The price is moving in your direction. You're up $300. Your profit target is $600. You're halfway there. Everything is going perfectly. But then something happens. The price pulls back a little. Just a small pullback, nothing serious. But that pullback makes you nervous. You start thinking about all the ways this trade could go wrong. What if the price reverses completely? What if I lose all my profit? You feel an urge, a strong urge, to close the trade right now and take your $300 profit. Lock it in. Make sure you don't lose it. So you do. You close the trade early. You take your $300 profit instead of waiting for your $600 profit target. And then something happens that happens constantly to traders like this. 30 minutes later, the price bounces back up. It reaches your original profit target of $600. If you had just waited, you would have made $600 instead of $300. You would have doubled your profit. But you didn't wait. You got scared. You cut your profit early, and you left $300 on the table. This happens to traders constantly. Not once, not twice, over and over. They cut their winning trades early because of fear. And over time, these early exits cost them thousands of dollars. In fact, cutting profits early might be the single most expensive mistake traders make. It's more expensive than bad entries. It's more expensive than using too much leverage. It's more expensive than trading without a stop loss. And the worst part? Most traders don't even realize they're doing it. They think they're being smart. They think they're protecting their profits. They don't realize they're leaving massive amounts of money on the table. But understanding this mistake is only the beginning. To truly stop doing it, we need to understand how fear works. Fear is an ancient survival mechanism. Fear was designed to keep us alive. If our ancestors heard a noise in the jungle, fear would make them run away. That fear might save their life. But in modern life, fear often works against us. Fear makes us avoid things that are actually safe. Fear makes us do things that hurt us. Fear makes us irrational. In trading, fear manifests in a specific way. When a trader has a winning trade, they start to feel afraid. Not afraid of the market, afraid of losing what they have. This is called loss aversion. It's a psychological phenomenon where the pain of losing something is much stronger than the pleasure of gaining something. Studies have shown that losing $100 feels about twice as painful as gaining $100 feels good. So when a trader is up $300 in a trade, they don't think about the possibility of making $600. They think about the possibility of losing the $300 they already have. And that fear of loss is powerful. It's powerful enough to make them close the trade and take their $300 profit. But here's the thing. By closing the trade early, they're actually creating more losses. They're cutting their winning trades short. They're not letting their profits run. And over time, having small winning trades and large losing trades is the fastest way to destroy a trading account.
Now that we understand the fear mechanism, let's look at what actually happens inside a trader's mind when they're in a winning position. First, there's excitement. The trade is working. The trader made the right call. They feel smart. They feel good. Dopamine is being released in their brain. They're experiencing pleasure. But then there's a pullback. The price moves against them slightly. The excitement disappears. The pleasure disappears. In its place comes fear. The trader starts thinking, what if this pullback is the beginning of a reversal? What if the price turns against me? What if I lose all my profit? These thoughts are natural. These thoughts are normal. Every trader has these thoughts when their trade pulls back. But here's the key difference between successful traders and unsuccessful traders. Successful traders recognize these thoughts as fear-talking. They recognize them as irrational. They don't act on them. Unsuccessful traders? They act on these thoughts. They close the trade, they take their profit, they calm their fear. And this becomes a habit. Every time they're in a winning trade and there's a pullback, they close it. They take their profit early. They never let their trades run. Over time, this habit becomes very expensive. Understanding the psychology is important, but the real wake-up call comes when you see the numbers. Let's look at how expensive this habit truly is. Imagine a trader has a strategy where they win 55% of their trades. They lose 45% of their trades. When they lose $100. When they win, they make $200. Over 100 trades, here's what happens. They win 55 trades, making 55 times $200 is $11,000. They lose 45 trades, losing 45 times $100 is $4,500. Total profit, 11,000 minus 4,500 is $6,500. That's a very solid, profitable system. But now, imagine this same trader has the habit of cutting their profits early. They close their winning trades at $100 instead of letting them run to $200. Now the math changes. They win 55 trades, making 55 times $100 is $5,500. They lose 45 trades, losing 45 times $100, which is $4,500. Total profit, $5,500 minus $4,500 is $1,000. The same strategy, the same win rate, the same execution. The only difference is that they cut their winning trades early, but their profit drops from $6,500 to $1,000. That's an 85% reduction in profit. And if markets are choppy, or if that trader gets even more nervous and cuts their profits at $50 instead of $100, the results look even worse. This is why cutting profits early is so expensive. It completely undermines even a good trading system.
These devastating numbers get even worse when you understand how cutting profits creates a repeating pattern that destroys accounts over time. Here's how it works. A trader is in a winning trade. They cut it early and take a small profit. They feel good. They feel like they won. They feel like they protected their money. But then they take another trade. This time, they stay in it too long, and it turns into a loss. Now they feel bad. They feel like they lost. They take another trade. They cut it early, small profit. They feel good again. Then another trade. They stay in too long, big loss. They feel bad. This cycle continues. Small profits, big losses. The account slowly declines. But here's the psychological problem. The trader feels like they won twice as often as they lost, because they had 3 small wins and 2 big losses in this scenario. They won 60% of the time, but they still lost money overall because the losses were bigger than the wins. So the trader thinks their strategy is working. They think they're doing something right. They don't realize that their strategy is destroying their account. Meanwhile, they're becoming more and more afraid of losses. Each big loss makes them more nervous. The more nervous they get, the earlier they cut their profits. The earlier they cut their profits, the bigger their losses become relative to their wins. It's a downward spiral. This fear cycle works because traders justify their behavior with logical-sounding reasons. But these justifications are actually masking the real problem. Common things traders say: I'm taking profits while I can. A profit is a profit. I'd rather have a small win than risk turning it into a loss. I'm being realistic. I know the price isn't going to run forever. I'm locking in my gains. All of these sound reasonable. All of these sound like the trader is being smart and cautious. But they're not. They're actually destroying their account.
They're cutting off their only real source of profit, winning trades that run far. The truth is, winning trades that run far are the only thing that makes trading profitable. If you have many small wins and a few large losses, you lose money. But if you have many small losses and a few large wins, you make money. This is the entire foundation of successful trading. Let your winners run, cut your losses short. But most traders do the opposite. They cut their winners short. They let their losses run. And they wonder why they lose money. But here's where it gets important. Not all early exits are bad. We need to understand the difference between fear-based exits and genuinely smart trading decisions. Smart trading sometimes means closing a trade early, but it's not because of fear. It's because the setup has changed. The reason you took the trade is no longer valid. For example, a trader might take a trade because they expect the price to break above a resistance level. If the price breaks above, they hold the trade. But if the price bounces off the resistance level and breaks below a support level, the setup has changed. The reason for the trade is no longer valid. Closing the trade is the right decision. But this is very different from closing a trade early just because it pulled back a little bit. Smart traders have rules for this. They might say, I will hold this trade until my profit target is hit, unless the price closes below this specific support level, in which case I will exit immediately. This rule removes emotion from the decision. It tells the trader exactly when to exit, no matter what they're feeling.
Once you master smart exits versus fear exits, you realize there's another silent killer, the compounding effect of small, consistent profit cuts. Let's say a trader has $10,000 and makes 10% per month. After 12 months with compounding, $10,000 becomes about $31,000. But if that same trader cuts their profits early and only makes 3% per month instead of 10%, then after 12 months, $10,000 becomes about $14,260. The difference after 1 year is $16,740, but after 2 years, the difference is enormous. After 5 years, the profitable trader has over $200,000, while the unprofitable trader is probably below their starting amount. This is the hidden cost of cutting profits early. It's not just the immediate loss of additional profit, it's the compounding effect. It's all the future profits that won't happen because your current account is too small. Now that you understand the problem and its cost, let's look at practical, concrete steps you can take to fix this habit today. Here are some practical steps. Step 1. Set your profit target before entering. Before you even click the buy button, you should know exactly where your profit target is. Write it down. Make it specific, not somewhere around here. Specific, like $100 or 150 pips or 2%. By closing your platform, you remove the temptation. You can't close a trade early if you're not watching it. By closing your platform, you remove the temptation. You can't close a trade early if you're not watching it. Step 5, do something else. Go for a walk, read a book, watch a movie, spend time with family, anything except looking at your charts. This gives your emotions time to settle. By the time you check your platform later, the trade is either closed or the emotions have passed.
These practical steps work, but they only stick when you understand the deeper reasoning behind why profit targets matter so much. The profit target isn't just a number. The profit target represents your expected return for the risk you're taking. It's the payoff for your trade. When you set a profit target of $200 and a stop loss of $100, you're saying, I expect to make $200 on this trade if I'm right, and I'm willing to lose $100 if I'm wrong. This is a calculated decision. You've already decided that the potential profit is worth the potential risk. By cutting your profit early, you're second-guessing this decision. You're saying, actually, I don't need the full $200. The $100 profit is enough for me. But if $100 profit isn't enough for you, then your trade wasn't worth taking in the first place. You should have lowered your risk or found a better setup. The profit target exists for a reason. It exists because that's the payoff that justifies the risk. Cutting your profit early means you're taking the risk but not getting the full payoff. That's the worst possible scenario. When you truly grasp why profit targets exist, you start to see how the most successful traders think completely differently about winning trades. Successful traders accept small losses. They don't try to avoid them or escape them. They take the loss and move on. Successful traders let their winners run. They hold their winning trades until the profit target is hit. Sometimes the trade goes further than the profit target. Sometimes it reverses and hits the stop loss after going up a lot. But they don't cut it early. Over time, this approach creates a portfolio of trades that looks like this. Many small losses, a few large wins. The large wins more than pay for all the small losses. This is the only way to be consistently profitable in trading. But it requires discipline. It requires trusting your system. It requires resisting the fear that tells you to close your winning trades. Successful traders have systems that help them do this. They use profit target orders. They close their platforms. They keep trading journals. They review their trades after the fact to see what their average profit would have been if they had held their trades longer. By doing this, they remind themselves why cutting profits early is expensive. They remind themselves why holding winners is important. Fear is powerful. It sneaks up on you, whispers in your ear, and convinces you to do things that hurt, like cutting your profits early. This little habit, it's one of the most expensive mistakes a trader can make. It doesn't just sabotage a single trade, it undermines your entire system. It keeps you from ever really becoming profitable. But here's the good news. This habit can be broken. Yes, you can break it. It takes discipline, it takes systems, it takes reminding yourself why you even set your profit target. If you can overcome the fear that screams, "Take it now, lock it in!" If you can hold your winning trades until your profit target is hit, congratulations! You've just taken a massive step toward becoming a profitable trader. Remember, the market doesn't care if you're scared. It doesn't give you gold stars for protecting your profits early. The market only rewards you for letting your winners run. So, here's the game plan. Set your profit target, trust your system, close your platform, and let your winners run.